Complicated? Accrue lets you focus on what is really important. Life. Invest in premium commercial real estate for as low as $1,000 without hassle and worry. Accrue. Making the exclusive inclusive.
Well, a huge thank you to Joseph and Ziv there for our insights. Now we're halfway through the day, but don't go anywhere. We have some fantastic discussions coming up next. Our next guest made a recent headline with his startup acquisition for $160 million by Forge Global. So here to share his story and how private security marketplaces derive liquidity for digital securities, please welcome Greg Brogger from SharesPost alongside Noelle Acheson from CoinDesk.
Hi everyone, and thanks very much for joining us for this fireside chat with Greg Brogger, the CEO of SharesPost. I'm Noelle Acheson, Managing Director of Research at CoinDesk, and I've been particularly looking forward to this session because it brings together traditional financial markets and the financial markets of tomorrow, and that is the area that I am most excited about in the cryptocurrency and blockchain industry, because it's where I think that the potential will have the biggest impact, not just on how we save, and not just on how we invest, and not just on how we raise funds, but how we function as a society, because capital markets are about so much more than number go up. They're about so much more than returns on portfolios. So Greg, seriously, thank you very much for being here.
Thanks, Noelle. Thanks for having me, and thanks obviously to everyone who's making this broadcast and this event possible. It seems like it's been really interesting so far.
I certainly learned a lot so far, I must say, and I'm sure we're going to be learning a lot over the next 30 minutes. But Greg, before we dive into the topic at hand, let's zoom out and set some background. Tell us about SharesPost.
Sure. And one quick correction just on your introduction. Thank you for it. But so I'm no longer the CEO of SharesPost, as was mentioned. So with the Forge merger, it's now a subsidiary of Forge. But just maybe kind of going back a little bit into the story of SharesPost and how we launched it in 2009. It was just coming out of the financial crisis, and what we've sort of recognized there was that there were these somewhat tectonic-sized shifts in the capital markets, and you started to see the first companies, Google, and then of course Facebook, opting to defer their IPO. And as we looked into that, we thought what we might be seeing is the beginning of a long trend. And what most people don't recall is that Facebook was the first unicorn, and we called them a unicorn because they were the first of their kind and only one of their kind. So they were this sort of exotic animal, and obviously we bet that there would be many more to come. And now I think there's something approaching 600 with a total market cap of over $2 trillion. So the world has certainly changed.
It certainly has, and I know that you've been part of that change. You've been looking at security tokens for some time. Mm-hmm. I remember a couple of years ago reading about the work that SharesPost was doing with digital tokens, and I got really excited because, as I mentioned before, it's about bringing the two worlds together, the capital markets of yesterday and those of tomorrow. So walk us through the journey between starting to look at this new type of financing to where you are today. Why and how has it evolved?
Sure. Yeah, I think, the root driver for so much of this innovation is just frankly how bad the private market has been historically, right? So if you go back a decade and you look at venture-backed assets, private growth companies, it was sort of a backwater of private equity. And so a lot of the attention and technology and focus that are brought to it now is only because it's become big enough to deserve that amount of attention, right? The size of the asset, the demand for liquidity, and that's because private companies are staying private longer. So I think that's been the primary motivation. And in that world of 10 years ago, all of the secondary trading, all of the liquidity and much of the primary financing was held in a really tight-knit group of people that lived on Sand Hill Road or worked on Sand Hill Road in Silicon Valley. And outside of that very network community, very few people had access, and only companies with connections to that capital could really raise meaningful chunks of capital. So there was enormous pressure to a demand to globalize and make far more efficient and kind of break out and democratize access to these companies. And what we've seen is a steady movement on a bunch of fronts towards that end. I think it's, you look at any financial market and it may struggle. It may have fits and starts and troughs and valleys, but it's like water seeking its own level. So there's more and more data coming into the market. There's more and more transactional efficiency. There's more and more educated investors that know how to value these companies, and all of that is sort of a groundswell. And I think, frankly, digital securities, and not just digital securities, but digital securities tied to networks that can allow the integration and participation of existing major financial institutions, the largest investment banks. That's the next evolution, and that's what we're working on now.
Well, before we go on to the next evolution, pulling back a bit, you mentioned that private companies are staying private longer. Why is that? What are the inefficiencies in the market that have led to that situation?
Sure. So I think there's a bunch of different ways to look at it, either from a market structure or regulatory or founder preference. I think is actually one of the least discussed. But at the root, I think it's just the public markets have grown increasingly inhospitable to private growth companies, and because they become so much or so oriented towards quarterly earnings reports and sort of short-term discrepancies between forecasts and actual earnings as they come in, it's just very difficult for a company that's still in a hyper growth stage. So think of the most successful companies that we're talking about, from the Coinbases to Facebook back in its day, Uber in its day. These are companies growing at 50 and 100% per year. And so it's just not a good fit to ask that kind of company to know where it's, next quarter, its next 90 days, exactly, to the penny what its earnings are going to be. And it may be even something broader than that, which is, I think, increasingly these companies with the greatest opportunities to kind of change the world, those opportunities don't come in 90-day increments. They come in a year or 2 year. So it's really not an opportunity that's well suited for the day traders that you find in the public markets. Really, one of the great advantages for private companies to remain private is the investment horizon of people putting capital to work is 1 year, 2 year. It's a bet on whether the company will bring a new technology to market or open a new geographic region for its business. It's not, as I said, based on these very technical public market type valuations on very small increments of value.
Yeah, and speaking of valuations, many of these companies don't even have earnings that
Right.
we can project going forward.
Right. Yes, and so I think one of the topics I'm guessing that we're likely to get to at some point is a discussion of how SPACs interact with that and how they're impacting the private market. I mean, it is definitely a phenomenon of some size.
Yeah, exactly. You read my mind. That's exactly what I was going to ask you next. What do you make of the surge of SPACs, and why and why now?
Sure. Well, I mean, SPACs have been around, of course, for a long time, and I think part of the why now is that there's so much capital, seeking access to growth equity returns, and of course, growth equity returns are increasingly as there's been fewer and fewer public companies, and certainly fewer and fewer growth companies because they're all staying private. The pressure or demand for all kinds of investors for growth equity type returns, you just can't find that in the public market anymore. You have to come to the private market. And then if you kind of layer onto that the low interest rates and just the amount of capital being sort of steered into the equity markets by the Fed, just the economic conditions that we're in, and then layer on top of that this sort of pandemic driven explosion of day trading and more retail type investors getting into the market, it's kind of a perfect storm.
Yeah, nothing else to do, so I'll stay at home and trade. And again, pushing out on the risk curve as well. If we're not going to be getting yield, we might as well go for returns, and that does involve a higher risk. And when you're talking about private companies that you mentioned before, especially those without clear earnings path, and you have SPACs swooping in to offer them financing, how does that change the financing profile of, say, a mid-sized tech company that's just getting started?
Well, I think it's not even as you said, it's not even really mid-sized companies. I'm hearing about Series B preferred stock, preferred financing companies that are like 2 years old, 3 years old, preparing now to be a public company. And I think it's very difficult for a management team or a board or shareholders when that amount of money, when you're a Series B company and a SPAC shows up and says, "I've got $200 million raised," you're not going to hear no a lot to that. I mean, it so de-risks the company. It's really only going to be the companies that are strongest, that have are most confident in their access to capital, which Many times it's going to be because of the quality of the VCs and the depth of their pockets. But for anybody other than that very top of the pyramid type company, it's going to be hard to say no. I guess the challenge is there's still only so many good Series B companies, and you now have a lot more money chasing those companies. And so I think I'm not exactly sure how this SPAC market's going to end, but if too much money chases too few deals, it doesn't tend to end well. And I think what these companies also have to consider is, yes, there is a flood of capital when they close a SPAC, but then they are a publicly reporting company. And do they have the infrastructure to be a publicly reported company? Do they have the stability? Do they really think, will they be able to generate sustained investor interest of a kind that will drive future liquidity as a public company? Because there's many public companies that have an exciting debut, but then a year or two later are somewhat orphaned. So, I think one of the paths, and I think as you know, I'm now on the board of a company called Onera that's championing a version of a digital security that I think fits very neatly into the capital stack of these kind of, call it mid-range Series B to Series C, D, E type companies. So maybe $200 to $500 million in market cap that might give them the benefit of liquidity and efficiency and scalability in their access to capital, but without the burden of being a publicly reporting company.
We saw earlier today the reveal of FinP2P, which is fascinating, bringing in all the different blockchains that have been working on securities tokens for some time. So it sounds like the missing piece, as it were. But how does that then, in your view, facilitate not only a fairer access to the financing, but also a better deal for the investors? Sure.
Well, I mean, I think it's certainly superior from the company's perspective, just because of the level of distribution that they get. So if I think as Onera and the FinP2P working group have just done an amazing job of bringing together. I don't know what the final number, but last time I looked at something like 80 kind of major global financial institutions are now in one form or fashion supporting or integrating into it. What that means is, rather for a founder raising capital, is rather than the network of who I know or who I've done business with in the past that I can go out to for money, I can now gain access to thousands of investors and essentially that hold unlimited amounts of capital. And that doesn't mean every company will raise money, and it doesn't mean every one of the institutions on the network will choose to distribute a particular offering within its clients, because it's a very permission-oriented sort of system. But just that basic infrastructure competes so favorably with what the private market process of a financing is. And any of the people watching who've conducted this will know what that means. I mean, that's months of meetings, schlepping from one VC to the next VC, putting up a PowerPoint. It's a very protracted process. The legal expenses are quite substantial. And so all of that expense and time is a distraction from the building of the business. So if you're asking how do investors benefit, I think they benefit from the exposure to many more deals than they would otherwise see, significantly faster, more efficient transactions with lower transaction costs. And then the big win, of course, is secondary liquidity is sort of baked into the nature of the digital security class with this FinP2P network and the institutions that are on it. And so we talk about a company like Coinbase, and right now, essentially what they're doing, unfortunately, these, a version of the manual auctions that we did on NASDAQ Private Markets. That was part of my background, was as the original president of NASDAQ Private Market. Essentially, it is an auction-based system of a kind that you could just run on an Excel spreadsheet. It hasn't fundamentally moved forward the operation of a market. Right, connection and settlement and clearing. It's just the scale at which they're running the same old process.
And when you go back to what markets were originally for, which is price discovery, let alone access to savings and financing, we get a sense of how they sort of lost their way. And you know more about private markets than pretty much anybody out there today. So we see that this is better for the issuers, and that's therefore better for the investors because they have more choice, because it's better for the issuers, and the cost as well. But what about habits? I mean, how do you go about changing habits? People don't like that generally.
Yes, and it's habits habits that have made the existing players, enormous amounts of profit. And so they're, the winners in the existing game are always the last ones to choose to start the next game, right? And so that's the transition we're at. And in addition, just to inertia and the way that these, the largest investment banks and others are sort of organized around existing lines of business where people are doing quite well and therefore not particularly motivated to shake things up. You have a regulatory overlay, and that, if you're trying to get people to do new things, based on some combination of fear and greed, there's the fear aspect around for the issuers and counselors around what the SEC, I'm just focusing from a US perspective, but how the SEC might look at this stuff, particularly when they came out so strongly in opposition to it initially, it just created this cloud. And so I think it's taken us to the point where we are now, where there's so much infrastructure, so many players from all different sort of levels, from the largest institutions to the smallest startup, that are just waiting and clamoring. I think it's for the first time we're going to start to see some companies go first, issue digital securities. We just need a couple of success cases to really broaden it enormously. And we saw that in 2009 with the first Facebook trading on SharesPost. So it can happen very quickly when it happens. And so I think those that are laying the groundwork for it, are well positioned and doing us all a great service, because it takes a certain kind of bravery to go into a market that doesn't yet exist but should, and push for it to come into being.
And we are seeing some digital securities already starting to trade, the brave souls like INX, for instance, that actually went through all the right hoops, and more power to them. Many in our sector criticized Coinbase for not taking that step, issuing a security token rather than going the traditional IPO route. And they do have a provision in their S1 that opens the door to that in the future. What do you think their reasoning was there?
Well, I'm purely speculating, and obviously I wouldn't speak for anybody at Coinbase or for Coinbase, but I do think, it doesn't surprise me, I guess is what I would say, which is, I think maybe Coinbase, or boards and management are beholden to the shareholders, and that's where their duty lies. And so if there is a somewhat riskless way to accomplish many of the same goals that you would get from digital security, it's risk avoidance, I guess is how I'd put it. Maybe they feel they've done enough innovative on the cryptocurrency side that they don't need to also simultaneously put things at risk by blazing a trail on the digital security side. So, I think it's a company like Coinbase will have all the market attention and support from financial institutions that a public company could want. And so for Coinbase, what incremental benefit do they get from a digital security offering to offset the risk of doing something new with such a gigantic or enormously valuable company?
Absolutely. The size was no doubt part of it. And what I mentioned before about habits, they want to go to where the investors are rather than force them to come where you are. Incremental change. Do you see platforms such as, FinP2P influencing IPOs, the number on size of going forward?
So you said of IP hosts?
IPOs, yes.
Oh, IPOs. Certainly over time. And I think, you can, in all of these conversations that we have with the largest institutions, I genuinely, and maybe it's a self-selecting crowd, maybe the people at these institutions that I'm talking to are already, they've drunk the Kool-Aid, so we're all just reinforcing each other's beliefs. But there's nobody who doesn't believe that digital securities are the future. And again, it's because the competitive solution to that is so bad, right? It's, as I think Ziv was describing on the prior panel, it's weeks of negotiation on customized documents with expensive brokers and expensive lawyers, and then maybe it closes in 90 days. That's so horrible. There's so much pressure